Well, this morning, before I dive into market data and points about mortgage rates and mortgage-backed securities, there's a lot of data to talk about that's going to happen this week. I want to take a moment and just reflect on September 11th, 2001. I remember the time interest rates came out still on fax paper. So paper fax, we'd receive an actual rate sheet from each investor every morning that was faxed over. And I remember I was at the office early that morning. It was busy. It was a busy season in 2001 as things were beginning to pick back up. Actually, they were still pretty fast moving from the 2000 time period and 99 time period where we had a major economic boom. But I was there at 7 in the morning, 7:15 in the morning. That's typically when we receive the faxes coming over, because Eastern time at 9 o'clock or so is when rates came out. So over here in Mountain time, about 7 o'clock, 7:15, 7:30, we'd see them. And I saw a number of these rate sheets come over saying markets are closed due to events in New York City and Washington, D.C. Markets are closed today. And I hadn't been watching the news. I was busy pre-approving clients and working on files for my clients that were trying to buy homes. So I had no idea what was going on. So I turned on the news to see what was happening, and was very shocked at the events of that day and the massive casualties and loss of life in the nation at that time. It was shocking. The good that came out of that, by the next day, of course, we saw reports of heroism and people who were sacrificing their own life to save other people's lives, and the sense of unity that the country felt in the days that followed that and the weeks and months that followed 9/11 was wonderful to see. I hope that we can have that sense of unity and purpose as a country again sometime soon, without having to have significant, major, negative, heartbreaking events to cause us to come together as a people. So that's my thoughts and my plea for today. I do, however, want to pivot a bit here and talk about this week. We do have quite a bit of news coming out this week. On Wednesday, we have the CPI, the Consumer Price Index, which is an inflation, of course, index to see what's happening with inflation. Hopefully that's continuing to cool, but we'll find out on Wednesday. Then on Thursday, we have the PPI, which is the Producer Price Index for wholesale inflation. Both of these indexes are being watched closely by the Federal Reserve as they try to make a decision 9 days from now on September 20th as to whether or not they will continue to raise their overnight interest rate or pause and keep it steady where it is. Nobody expects them to drop it, so that would be a really big surprise to the market, which I don't anticipate will happen either. But the question is whether they'll continue to keep it at its current level and pause for a number of months and see what happens with the rapid rises that they've already incurred upon the on the markets the past year and a half, or whether they'll raise it another 25 basis points to continue to cool the economy off. So it'll be an interesting day. But there are differing opinions out there from the Federal Reserve. Differing Federal Reserve governors are going to the media with different opinions about whether we should hike or pause, and it seems to be a pretty big mix. I mean, there's a lot of dissent right now within the Fed on what to do next. They don't really know. Here's one indication. I'm going to show you this. Find this interesting. One indication of this dissent, of the difference of opinions, is the GDP estimates for Q3. You have the Atlanta Fed saying they expect GDP to be 5.6% growth. The New York Fed only 2.25% growth, and then the St. Louis Fed negative 0.25% growth. So we've got some wide-ranging opinions on how the economy is reacting to the major increases they've already enacted. There's also recession odds that are out there that are measured. Now, Goldman Sachs is not part of the Fed, but I know they have outsized influence, of course, on the Fed. But Goldman Sachs is an investment firm. They're only saying it's a 15% chance of recession. Of course, they have to protect their book of business. They're an investment firm. They don't want their investors getting scared and not investing. So I would take their prediction with a huge grain of salt based on their business model. But the New York Fed says there's a 95% chance of recession, and the Cleveland Fed says 75% chance. Now, the silver lining to recessions is that interest rates come down during recessions, and housing typically, is okay. I mean, with the exception of the last recession, which was caused or led by housing, most other recessions over the last 30, 40, 50 years have not been housing led, but actually have housing has pulled the country out of recession. So we'll see what happens. As long as people don't lose complete confidence in their ability to make money and have employment stability and get scared from spending money at all, if it's a minor recession, it'll be okay, because interest rates will ease and we'll have more housing activity. So that'll be the silver lining to it. Now, if it's a severe recession that just scares people to death and they don't know what's next and they hunker down and decide not to move and not to spend money, yeah, that could affect us in the housing industry and the mortgage industry for a period of time. So let's hope it's not severe. Let's hope it's mild and we move forward and the Fed is able to successfully engineer this soft landing they've been desiring since they started this process. Taking a look at the markets real quick here, let's take a look and see where we're at. Today, the universal mortgage-backed security, as you can see here, is down 8 basis points in price. It was down as much as 14 basis points this morning. So unfortunately not, great on the heels of Friday, but not awful either, just slightly worse. And the 10-year Treasury is up at 4.28. So hovering up there at the near peak that we've seen, or right at near that peak we've seen the last few weeks. And then last October, we're still up there at that high point, at high water mark. So what's going to happen going forward? Well, this chart's a little bit messed up here, as you can see, but from last, in fact, let me just see if I can refresh it and make it look better. We're right at the 25-day moving average, as I'll show you here in a second, which is a pivotal point. We're kind of floating above and slightly below that 25-day moving average on the universal mortgage-backed securities. So this week's inflation data will be pivotal, and markets will be watching that closely, and it could swing the rates for mortgages one direction or the other fairly significantly. As you can see, we're stuck on this 25-day moving average. If we get an improvement in pricing and improvement in rates, we got a ways to go, and we could see a decent amount of improvement, maybe up to an 1/8% better in interest rate, but it could easily go the other direction as well. So yeah, I don't know what to tell you as far as which direction it's going to go for sure. Nobody knows that for sure, but I do know that we could see quite a bit of volatility over the next 3 days as we have a major 10-year note auction happening tomorrow. And then Wednesday, we have the CPI, Thursday, the PPI. So if you have clients who have gotten under contract for a new home over the weekend, I'd probably be advisable to lock in today or by tomorrow morning, depending on their closing time frame, assuming they're going to close within the next 2 to 4 weeks. With that, hope you have a wonderful day. I put a CTA here, a call to action in this video with a link to my YouTube channel. Please subscribe to it where you can access these market rate updates and go back and take a look at them over the past number of months. They're all, archived there. And of course, these new ones are there as well, so they're easy to share with others. Thank you. Have a wonderful day.